Hello everyone, welcome to the course Financial Mathematics for Actuaries. In this week, we are going to learn the topics related to bonds and the valuation of bonds. Specifically, we are going to learn the various types of bonds and also various types of risk in investing in bond, and also eventually we are going to learn yield to maturity, and also we are going to extend our learning to valuation of assets or valuation of bonds. Okay, so let's start with the concept of bond. Let us now understand why a firm issue bond. So remember that if you want to start a business, how you will acquire fund? If you have enough money to support your raw materials, then actually you are making your equity investment. So the owner invested all their own savings to buy the materials necessary to start the business. Then they made an equity investment in the company. This only possible if you have sufficient amount of fund. But if you do not have sufficient amount of fund, meaning that if the owner does not have enough fund to support its business or project, then he will either borrow or you can seek a partnership, right? So you will seek loan from the bank or you can look for partnership, in which case you have to share some of your profit. So to start a new business or to fund a new project, a company can raise fund in two ways. The first one may be issuing these shares. You might be knowing the stocks. Okay, so a firm can issue stocks or shares, or a firm can issue bond by incurring the debt. Means basically it issues the bond. Okay, so by issuing debt or bond rather than issuing stock, the firm actually secure funding without diluting ownership, and they benefit from interest payment that are sometimes tax deductible. This is the main advantage why the firm goes for debt financing. So if the firm needs fund for a very short period of time, then basically it goes to banks. So it will rely on what is known as loan. So it can directly go to bank as for loan and for the short period of time. But what if the firm needs fund for long period of time? Then it generally issues bond. Okay. So if they need fund for long term investment, they generally issue bonds which are simply a long term loan. So bonds are also a loan which is meant for long term basically, right? So firm issue bonds to raise capital for long term projects, its projects expansions, its acquisitions, or to refinance the existing or more expensive debt. So to meet all these or any of these, firm may issue bond. So this is the reason any firm goes for debt financing rather than is stock financing. Okay, so what we have learned now is like how a firm raise fund. So a firm raise fund either by issuing debt or bond or by issuing stock. While issuing stock, it has to compromise with the profit sharing. Okay, but on the other hand, if the firm choose the debt financing route, that is issuing the bond, then the firm is not diluting its profit, but the firm has to repay the principal along with the interest amount. Even if the firm is not profitable enough, the firm has to make a regular payment of interest and then finally the principal. That is the only difference. So, what is a bond? A bond is a debt instrument that represents a borrowing arrangement carrying a specified rate of interest. It just look like the loan what we have learned in the previous week, right? So, it is a certificate issued by the borrower or the issuer to an investor, who is generally known as the holder, acknowledging that a certain amount of money, that is the principal, has been borrowed and will be repaid at predetermined maturity date. So, the future is just look like the loan future. Only difference is firm generally goes for issuing the bond if it requires the fund for the long term purpose rather than short term purpose. So, interest payment on the bond are made periodically at the agreed interest rate. These interest rate, when the firm issue the bond, is decided on the basis of the interest rate that was prevailing most of the time, the interest rate that was prevailing in the market. So, a bond generally characterized with a face value. Okay, par value is also known as face value. The face value is the amount of or the amount that is written on the face of the bond, meaning upon maturity that much amount is liable to pay. And the coupon interest rate, the interest rate on which the loan or the bond is actually repaid, that is the coupon interest rate, which is stated on the face of the bond, and also the maturity date. Okay, and if any collateral or any security is deposited against the loan or the bond, that also will be mentioned there, that is the collateral deposit. For example, a bond having a par value of 1000 rupees with a 8% coupon rate mature in next 5 years. That date specifically is mentioned, but let us understand that, okay, mature in 5 years. So, this is just a very simplified example to understand the characteristic of bond. Okay, so bonds, let us understand this in the uh, investor perspective. Bonds are basically a fixed income instrument because you are expecting the rate of interest periodically. Okay, so it provides a fixed income in the form of interest. Okay, now let's compare with the stock. So, in comparison to stock is basically, if you are holding the stock of a particular company, actually you are holding a partial ownership of that company. That means you are actually eligible to get certain percentage of its profit, right? But on the other hand, if you are a bond holder, you are not earning, or you are not taking any share of the profit, but you are getting the interest periodically, and in the final or the end of the term you are going to get the principal. So, when you buy a corporate bond, you do not own equity in the company, rather you will receive only the interest and principal on the bond, no matter how the profitable the company becomes or how high its stock price climbs. You cannot claim, okay, its profit, and you cannot actually claim the stock. But if the company run into any kind of financial difficulties, right, it still has the legal obligation to make a timely payment of interest and principal. And in a situation of bankruptcy, bond investors have the first priority over the shareholders, okay, in claiming the company's asset. So, it is the bondholder who will get the first priority in case the firm goes bankrupt. The bondholder will get the first chance to claim the financial assets or company's asset. Okay, so let us now discuss the risks that are associated with bond investment. So the most important risk associated with bond investment is known as default risk. What is default risk? This is the kind of risk arises mainly due to the chance that the issuer will default on its bond. So one key risk to the bondholder is that the company may fail to make timely payment of interest or principal. If that happens, the company will default on its bond. This is known as the default risk. This default risk then make the creditworthiness of the company, that is its ability to pay its debt obligation on time, an important concern to bondholder. Okay. So bondholder therefore will look for the credit worthiness of any kind company, okay, or the company in which you are planning to make an investment. You first observe what is the credit score, or like what is the credit worthiness of the company. Remember that some of the rating agencies, okay, rate the companies on the basis of their credit worthiness. So default risk is there. Default risk basically means that the probability that the firm may go bankrupt or may fail to make timely payment of interest and principal. So another type of risk which is associated with bond investment is the interest rate risk. Note that a bond normally has a fixed coupon rate based on the rate prevailing in the market. However, after the issuance of the bond, the market interest rate may change, but the coupon rate may be same till the maturity date. So, for example, a bond having a face value of 1000 rupees issued at a coupon rate of 10% when the market interest rate is also 10%, right? The market price in this case is therefore 1000 rupees. If after the issue of the bond, suppose that the market interest rate moves up to 12.5%. This 12.5% is the current market interest rate after the issue of the bond. Now, the question is, will you buy the bond with the same 10% coupon rate? The answer is no, because the value of the bond declines if the interest rate increases, right? So, unless the bondholder reduce the price to 800 rupees, no one will like to buy the bond, because you calculate the current yield as 12.5% only if the selling price is equal to 800. Okay, so only if you will get this 1000 rupees bond with a discount price, that is 800, then only you are willing to buy this bond, otherwise no. So note that when the bond is selling less than the face value, then we call it as bond is selling at a discount. When the bond is selling at a higher than the face value, then we are saying that, or we will say that the bond is selling at a premium. So when the market interest rate is greater than the coupon rate, the market price of bond declines, right? And when the market interest rate is less than the coupon rate, the market price is increase. Okay, this will cause the risk, or we will call interest rate risk. So the variation in bond price causing due to the variation in interest rate, therefore is known as interest rate risk. This is directly influence the bond instrument or the debt instrument. Okay, so the other type of risk associated with bond investments are known as inflation risk or purchasing power risk. So the risk that the fixed interest payment will not keep pace with rising inflation. That means it reduces the purchasing power. The purchasing power risk refers to the variation in return caused by the inflation in the market, in the economy. Okay. When an investor purchases a security, he foregoes the opportunity to buy some goods and services, meaning that he is postponing his present consumption. So, there is always a risk attached. Remember that why you deserve interest rate on your saving. Firstly, you deserve interest from your saving because the presence of inflation first, right? Because you may not able to get the same amount of goods and services after 1 year or 2 year, okay, because the value of money will decrease, decrease after some period of time. This is due to inflation, okay. And the other is like you deserve interest on your saving because the moment you willing to lend, okay, you are actually compromising your present consumption, meaning that you are now ready to postpone your current consumption to future consumption, and therefore to compensate this you need some interest. That same logic applies here. When an investor purchases security, he forgoes the opportunity to buy some goods and services, okay. That means he is postponing his consumption, okay. For this purpose there is a risk involved. Also, another kind of risk you can see in bond investment is liquidity risk. What is liquidity? By liquidity we mean that the speed that you can able to convert your asset into cash, okay. So, how quickly you are converting the asset into cash is known as liquidity. So, the risk that you may not able to sell your bond quickly or at a fair price before the maturity is known as liquidity risk. Okay. Another kind of risk is reinvestment risk. So, the risk that you will have to reinvest cash flow, okay, like coupons or mature principal at a lower interest rate is generally known as reinvestment risk. Another type of risk is call risk. So, sometimes the company will issue a type of bond that is known as callable bond, which we will discuss later, okay. In this case, the firm can anytime call back for redemption. So, this type of risk is known as call risk. The risk that an issuer will pay back the bond before the maturity, typically when interest rate has fallen. Okay. Then all of them are listed in one basket, okay, which is known as risk. But broadly, we can classify risk in investment is like either it is systematic or unsystematic. Systematic in the sense that the risk which are external to the company, in which case you cannot able to or the firm cannot able to control for the risk. But unsystematic risk are basically arises due to the internal factor of the company, right. So, and therefore at some extent the firm can able to control such type of risk. So you can list a number of risk, okay, or the number of the risk structure of bond investment depending upon when and how it occurs. But we can these are the most popular risk structure we can list it out. But I leave it to you. You can add on the type of risk depending upon the nature. Okay. So let's now discuss the types of bonds. The bonds that are issued by the government is basically known as the government bond, or sometime we will call GSEC, right? GSEC are the bond or the security that issued by the government. They are basically known as free from default risk. So, the bond that are issued by the government, because we trust the government cannot default on its bond. Okay. So, government bonds are usually known as default free or risk free bond. On the other hand, bonds are issued by the companies or the firms or the corporations are basically known as corporate bonds. These are the debt obligation of most of the private sector companies. Okay. These bonds, however, are not free from default risk, and therefore we will have a major concern of this risk or this type of bond. Okay, let us understand in more details this type of bond, but now we will also understand the bonds on the basis of the maturity. Okay, so bonds can be classified according to their maturity, which is the date when the company has to pay back the principal to the investor. Okay. So, maturity can be for short term, for medium term, or for long term. So, while we understood that firm issues bond generally for long term purpose, it does not mean that it will not issue bond for short term. It can also issue bond for short term purpose. So, longer term bond usually offer a higher interest rate, but they entail additional risk. Most of the time we call this inflation risk, because on the long run we will expect inflation to increase. Okay, or we will discuss it later when I will teach you the term structure of interest rate. There we will discuss why the long term bond actually have the higher interest rate than the short term bond, but for now we just understand that longer term bonds are usually offer the higher interest rate because of the possibility of additional risk of inflation. So, a bond can be a secured bond or it may be an unsecured bond. A secure bond in the sense that some bonds they are secured by collateral deposit or collateral asset, for example, mortgage bond, right? So, in the case of the secured bond, the company pledged specific collateral such as property, equipment, or any other asset that the company owns as the security for the bond. Right? If the company default, holders of the secured bond will have a legal right to foreclose on the collateral to satisfy their claims. Okay. But on the other hand, the bonds that are not secured or unsecured bonds are usually known as debenture. So, sometime remember, sometime we will use this bond and debenture interchangeably, but the difference is bonds are either secured or unsecured. We will call debenture only if they are unsecured by collateral. So, unsecured bonds do not have any collateral deposit. So, no collateral is offered against a bond. So, who will actually issue such type of bonds? Only the larger company, large corporations to whom people trust. Okay, because they are not unsecured by any kind of collateral. So, these are unsecured bond. Only thing you need to understand is the secured bond is backed by collateral. Okay, unsecured bond does not backed by collateral. So, the coupon bond and zero coupon bond. Sometime you can see a bond which does not have a coupon rate. Okay. So, usually the bond has the coupon rate, that is the interest rate attached with the bond. So, many bonds pay a fixed rate of interest throughout their term. The interest payments are called coupon payment and the interest rate is called the coupon rate. However, sometimes the firm or the authority will issue the zero coupon bonds. So, bond make no interest payment until the bond matures. Instead, the bond make a single payment at maturity that is usually higher than the initial purchasing price. Right? For example, you will see here an investor may pay 800 rupees to purchase a 5-year zero coupon bond with a face value of 1000 rupees. So, usually this bond will be available, like you can purchase when, as I have already told you, that when you can able to purchase the bond, okay, lower than the face value, then the bond is selling at a discount. Okay, when the selling price is higher than the face value, then the bond is selling at a premium. So, the company pays no interest on the bond for the next 5 years, and then at maturity it will pay 1000 rupees equal to the purchase price of the 800 plus the interest on, okay, or originally issued discount, that is 200 rupees. So, it will actually it is set in such a way that you will get the rate of return as the interest rate. But here, as the name suggests, zero coupon bond does not give you a periodic interest payment. Okay, however, on the maturity it will pay higher amount of face value. Okay, so now a company can issue a callable bond, or sometime it can also issue a convertible bond. Okay, so what is callable bond? Callable bonds are the bond on which the company can call for redemption prior to the maturity date. So it can, or it may be called for redemption earlier than its maturity date, and the right to call rests with the companies. And because it has an advantageous call, it must offer a higher interest rate to motivate, or the investors. Typically, a callable bond will become callable at a premium. And why do the company issue callable bond? To take the advantage of low interest. Okay, for example, suppose that during the issue of the bond, suppose the market interest rate is 8%, and therefore the firm has to issue the bond at 8% rate of interest. But the firm predicts that after 5 years or after 3 to 5 years, the interest rate may decline to 5%. But once you issued the bond, okay, at 8%, you cannot now go back and check, like withdraw this bond unless and until it is a callable bond. So, if the firm issue the callable bond, in which case it had the right to call back, okay, whenever it need or whenever it wants. So, if it predicts that in the near future the interest rate is going to decline, at this time, to take this lower interest rate or the advantage of lower interest rate, firm usually issue the callable bond. Okay, firm can also issue a convertible bond. The convertible bond in the sense that once it issued, the investor can convert it into equity shares. Okay, so those bonds that can be converted into equity shares at a later date, either fully or partially. So the option to convert often rests with the bond holder. Okay, and interest rate may be less because you have the opportunity to convert it into equity shares. Okay, then why company issue such convertible bonds? Company issue convertible bonds mainly for two reasons. One is because it generally have the lower interest rate. Okay, and also to delay the dilution. So it allows the issuer to delay dilution to its equity holder. And remember, the stock does not need to be issued immediately. Okay, so conversion to equity will happen at a much later date. Okay, a company may be in a situation wherein it prepares to issue debt security in the medium term, partly since interest expenses is tax deductible, that we have already understood, but is comfortable with dilution over the longer time because it expects its net income and share price to grow substantially over this time frame. Okay, in this case, it can force conversion at the higher share price, assuming that stock has indeed risen past that level. Okay, but why the investor want to hold this convertible bond even if the lower interest rate? Investor want to hold this to enjoy the potential share price. Okay, so convertible bonds of the company having high growth potential are very attractive because of the potential increase in the common share price. So when the firm grow big, okay, when you have analyzed that the firm has a growth potential, then at that time probably you are interested to hold such type of bond because you can able to convert it later. Initially you will start with bond, but later you can convert it into shares. Okay, so growth potential means that the price of its stock may increase dramatically in the short run. So what we have understood in this session is that what is the types of bond, what are the various risks involved in bond investment, and why a firm invests certain types of bond.